The Cboe Volatility Index down today, ending at its lowest in nearly 2 weeks, but problems may still lurk under the surface. Mandy Hsu is the head of derivatives market intelligence for Cboe Global Markets. Mandy, it's always great to see you.
Great to be here.
We've been remarking about sort of the, on the surface, everything looks calm on the, index level, but then individual stocks seem to have crazy moves. And you actually note that the volatility in individual stocks is much higher than the index level.
Exactly. So I think everyone looks at the VIX index as a measure of kind of broad market volatility. We also have an index for single stock volatility, VIX EQ. And if you look at the difference between VIX EQ and VIX, which tells you how much additional volatility is being priced into the single names, that recently hit an all-time high. Now, that spread typically widens going into earnings because earnings is a driver of single stock moves. But the extent of that, widening, of that spread widening, we thought was very notable. And I think it kind of speaks to this anxiety around earnings and valuation around some of the, the high flyer AI stocks and the tech names that we have seen so far this year.
You point out that the dispersion is market in stocks like Apple and Amazon. I mean, is there anything? So the anxiety surrounding the earnings for those particular stocks are much higher?
So the measure is market cap weighted. So it is much more driven by the large cap stocks, as, of course, is the S&P. But to a point of the dispersion, that is definitely a theme that we've seen this year where, you get a lot of volatility at the single stock level. But because they're all uncorrelated on any given day, certain sectors up, certain sectors are down. As a result, the index level volatility gets very muted.
Is there anything in that is some of the meme stocks which just have extraordinary volatility, even though they might not be that big?
Yeah, so that is not reflected into the VIX EQ. So the VIX EQ, I would say the index, you can think about it as the top 80 to 90 stocks in the S&P by market cap. So stocks like, Open Door or maybe some of the other meme stocks, that are out there, those volatilities would not be reflected into this index.
Mandy, on October 16th, the VIX, I think, put it 28 at one point, closed around 25. That was on a down day, but not a historically bad down day. And again, I think yesterday or the last couple of days, we've seen the VIX spike. Something's going on below the surface.
Exactly. So we've seen pretty meaningful shifts in terms of the positioning in the options market. I would say especially over the past week, we've definitely noticed a pickup in hedging demand. So investors actually buying downside protection, particularly as they're going out to year end, kind of locking their year-to-date gains, kind of looking out ahead and seeing kind of the risks out there and the positive performance in stocks and looking at the levels of volatility, like maybe this is a good time to start hedging. So we've definitely noticed that shift in investor sentiment and positioning.
Mandy, how about correlation between the bond market and the equity market? So it really feels as if the Treasury market's calmed down quite a lot. And it's calmed down in a bullish tint. In other words, yields are going lower, but it's relatively orderly. It does seem to be, for good reasons, not bad. What is that? Has that had anything to do with either equity side vol here, or does it bode well for something we should be looking for?
Yeah, I think what's going on in the fixed income market is very notable. Not only have yields come down, as you mentioned, but yields have come down at the same time. Inflation expectations are actually rising. So what the bond market is telling you is that the Fed is going to completely ignore any inflation risk and really focus on the softening in the labor market. And the market's getting very excited about this easing in policy. So real rates have collapsed this year, right? And that's what cross assets, trade on, and this loosening of financial conditions, which has been happening all year, even before the Fed started resuming cuts. That's been kind of underpinning a lot of the positive performance we've seen across asset classes.
Mandy, when you think about a lot of volatility we see in markets has to do with a lot of data. We don't have a lot of the data. There's still, trade stuff to be worked out here. We're going through earnings season. We have a Fed that's about to cut interest rates next week. I look out 1 month in the SPY, okay? So the ETF that tracks the S&P 500. I see options pricing a 3% move in either direction. So if you want to buy an at-the-money call or an at-the-money put, it costs you 1.5% of the index or the ETF to make that bet. Just talk to us about where that stands, the way you think about it. I know you've been looking at markets like this for a long time. It just seems kind of cheap, doesn't it?
Yeah, so I think the low levels of volatility, index vol, which we talked about, it means that the absolute premium for options, whether to the upside or downside, is going to be low, right? So I think that's why we're seeing an uptick in option activity, is people using those low levels to really express their views, whether bearish or bullish. You talk about kind of 1 month out or 3 month out. If you look at VIX one-day index, which looks at the next 24 hours, so we have CPI coming tomorrow, it's around, I think 80 basis points being priced in for tomorrow, which is really nothing. So not a lot being priced in for macro data, not really a lot being priced in the horizon. And I think a lot of investors are taking a look at this situation and saying, actually, maybe this is a good time to hedge.